Yeah, let's get started. Thanks again, everyone, for joining. We have Josh here today from Zapiio, Zappy.io, whichever one you want to go for. Zapiio, how would you, if you were to say like, what is the product? How would you describe it in like one sentence?
Okay, it's a portfolio modeling tool used to give yourself and clients clarity, I guess is really what we're trying to achieve here.
Yeah.
Uh, that's in one sentence. It's pretty much in a nutshell. Robust solution for portfolio modeling.
Beautiful, beautiful. Love that. Robust. I like that. Robust solution for portfolio modeling. And I've actually started using Zapier for my buyer's agency, and I'm gonna say it's awesome. It's like compared to the other products I've used, it's so much more detailed. It's re detailed and accurate, really easy to use. So like I started using it, I think like 3 weeks ago, and I was like, I had promised. What I did was I emailed a bunch of my past clients telling them to book a portfolio planning session with me, and I had like 10 of them book in the 1 week, and I hadn't even trained myself in Zapier by then. So I kind of forced myself that I was like, shit, I need to learn this really, really fast. And I was thinking, okay, I literally blocked out 12 hours to learn it. Honestly, it took me 2 hours and 15 minutes, right? I pumped through all of the videos on the HTAG Mastermind, practice, took an extra 30 minutes to practice creating one portfolio. And I was like, this is so much easier than I thought it would be. So I had an extra 10 spare hours and went to the hot springs with that extra time that I had. I don't know if Josh, if you've been down to Melbourne, but when you're next in Melbourne, Mornington Peninsula Hot Springs, that's pretty much my favorite place to go to. I'm a regular, so very easy to use. And and then like the main thing, I'm assuming majority of the people who are here today are buyers agents. I know a few of you will be actual like investors, which would this will be really useful for you. But for buyers agents and even just normal people, it's really affordable. Majority of these other softwares coming in at $750,000 per plan to access the software with some sort of an ongoing subscription. Whereas this is what tell us about the pricing, Josh. How is it priced? And then we're going to jump into actually showing it and using it.
Yeah, yeah, okay. So in terms of pricing, look, we're trying to do the right thing. We really want to see people using the software to give plans to clients. I guess the biggest thing that we've noticed is that being cost prohibitive is not the idea here. We really want to ensure that people are doing plans for their clients, increase the lifetime value of your clients, and really just giving people clarity and really mapping out a direction. So it's an invite based system. So what you can invite your clients for a free version, and that's a portfolio tracker. So I can show you a bit more detail how that works. But basically, we've got a tracker for say anything up until today what you already own. You might own one, two, three, or zero properties, right? So that's the foundation, and that's free for to give access to your clients once you're onboarded as a partner. Now, that's the foundation. If you want to do forward-looking plans, say I want to map out 1 to 25 purchases and residential, commercial, any of those sorts of scenarios, it's $100 to upgrade that client to advanced level access, and you can then run multiple scenarios. So you can run as many as you want. Basically, stack them on top of each other, compare A, B, C versus each other, add some superannuation if you've got SMSF portfolios. We really just want to let you give your clients access. Now, the interesting thing is that as an advisor or buyer's agent, you really want to hone in on building a robust portfolio. You do not want your clients to change that. So that's one thing that we've done. We've made it read only. For any plan that you generate for a client is read only within that $100. Now, I guess the cool thing is you should be reviewing these every year or every 6 months and doing a portfolio review. You tweak and adjust that plan or just create a new plan, I guess is the point. We also can do strategy as a service for you as a buyer's agent if you don't want to learn the software. There's a bit of a mixed bag there. So some people say, look, I want to just implement it as part of my system and just go all in and just learn like Asha did, 2 hours worth of time, understand how it works. To be honest, if you've got any questions, you can give us a call at any time anyway. Alternatively, if you don't want to do that and you've got a client that wants to do a plan, we can dial in as a strategist and do it for you. I guess the main advantages of that is you don't need to learn, which I really want people to learn though. I think it's powerful to learn how to use it, just to get
Mm.
your fundamental understanding of strategy. And it is really easy, like it's super easy. And then the other thing with the strategy as a service is that we can deliver it, and we're also working on behalf of you. You don't have to pay wages then, I guess. So that's 600 plus GST if you want to do that. Some buyers agents are starting with that, and then they learn because they sit there and listen, and then they learn how to do it, and then they do it themselves. Either one, as long as people are giving client centric advice, I think it's super powerful. Um,
Beautiful. Now, I love that. I reckon let's jump into the juice of today. So today, what we're going to do, I see there's a few questions. I'm going to get to those. I think we'll jump to those towards the latter part of the session because those are about the product and how it works. So today, what we're going to start off with is we're actually going to have Josh create a sample portfolio, right? So I'm going to pretend to be a client, right? And he's going to create basically a portfolio for me and like kind of almost give advice on the direction that we should take. But more so, and what we want to get from this is one, I want him to show you how the software is used and how easy it is to use, right? And then that's the first, I guess with Zapier, there's two things, right? Like one is how to use the software and getting really good at that. And
yeah.
then number two is getting good at understanding strategy itself, right? Now, with that is one, Zapier offers strategy as a service. If you're a buyer's agent and you don't want to run strategy sessions, or you feel like you don't have that knowledge, you can get Josh or the other team members. They've worked at some of in the strategy departments of some of the best and biggest buyers agencies, and they know their stuff, right? Like they know how to plan stuff, but at the same time, you can also learn these things, right? Like when should a client put a property under like all of these different things. And the other thing I like about Zapier is you can get your team members on it, right? It's a bit hard to get them to commit the time, but I had my first consult recently where we got this is a high net worth client. He's like income 800K, got heaps amount of equity. So the accountant and the mortgage broker, all three of us jumped on the call and worked on it, right? Usually, most accountants aren't going to make time to do that for every client, especially the ones that aren't high net worth. But if you have that knowledge, then that's something you can do yourself. Anyway, Josh, do you want to screen share and
Yeah.
let's show them what Zapier looks like, how it works, stuff like that, and then we can jump
You
into
have started screen share.
Yeah.
beautiful. And for those people who aren't buyers agents, I'm going to be saying client quite a lot over here. For you, if you're someone who's not a buyer's agent and you're using this, effectively the client is yourself, right? So you're the one that's going to be creating your own strategy. For those people who aren't buyer's agents and you're here, you can always reach out to us and we can help you create some sort of a strategy in terms of your investment direction. Anyway, Josh, let's jump into it and let's role play and create a scenario.
Yeah, so I just want to just touch on one thing early on. Can you see that it's all clear? Yeah. So this is your client list, and this is really important. So there's two distinctly different things here. There's advanced access and portfolio tracker, which I mentioned before. Now, what we're going to do today, I guess, is let's just start with a blank slate, and we can just show you how to add properties into the context of a portfolio. But just to identify, this is actually a really crucial part of the software. You know, just say you had 100 clients here and they've all got their actual portfolio that they currently own in there. This is free to track their portfolio. Like you literally go to the top right corner, get invitation link, send them your own custom link, and then they can enter in their information. And we're using this as the foundation to build out a portfolio. So the main differences are portfolio trackers in the past from today backwards, and advanced access is is forward. So we're going to just your name's Jan Jones for today, Arshad. I gave you a nice name.
Call
Um,
me Jan.
we're going to log in here and I'm just going to show you. So, you know, the portfolio tracker and the actual scenario based advanced access, they don't actually look too dissimilar. They don't look too different. But the functionality is what changes. Because we really want you to be able to send it to your client. They can figure out how to add their properties. They add it once, they replace their spreadsheet. So that's what I want to get that message across. You know, it's really powerful having a portfolio tracker that you can use to nurture your clients. And this is, I'll just give you some quick run through of what we've got here. This is an actual portfolio. And as you can see, it's just, actual means you currently own it. And this goes for normal, like as in outside of super and super. You can do both at the same time for their actual as well. So we can add up to 10 members into the portfolio. So, multi-generational families that own, 10% each, we can accommodate that. And then in super, we can have up to 6 members in that portfolio. In terms of how this works, and I'll show you once we start sticking some data in, just a bit of housekeeping. This is all dynamic. So the charting is dynamic, which you will see shortly. And you can actually click across. It's all based on financial years. We have accurate tax calculations in here for CGT and obviously tax. But first of all, we really want to onboard the client into the system if they haven't done it themselves, which normally you would just try and get them to fill out the data themselves. But we've kept the UX in this extremely easy to use. So you've either got properties, what are their income, savings, goals, liabilities, what loans are associated with their properties, and what does the cash flow look like. That's as simple as it is. And then when we add properties, we can do some pretty crazy stuff with entities if we want to, adding, granny flats and stuff like that. But we won't go too deep into it today. We'll just show you the bones on how to build out a portfolio. So what we'll start with, Arshad, in this situation is we need to upgrade this client's access. So I'm going to upgrade access level. And this is what I referred to earlier in the $100 conversation. You upgrade their access once and that's it. So once we've upgraded this, Jen is now, or Arshad is now advanced level. This now allows us to do forward-looking scenarios. So what we want to do is in their actual portfolio, we want to fill in all of their details, what properties they currently own, if they own any. If they don't own any, it doesn't matter. We're starting from a blank slate, but we need to input their financial information. So Arshad, let's just...
So let's say I'm earning 300, me and my wife together, we're earning 300K combined.
Yeah, so we'll
Right.
do this, and like I said, you can actually add multiple members in by just going to add member. So we could add your wife in if you're on different tax rates.
Yeah.
We'll make the cash flow of the property portfolio is super accurate, right? You just invite by email of whatever portfolio you want to invite to, whether it's normal or SMSF. Very, very simple. First step in the process, add the members of the portfolio. And now we want to start updating the information. So let's just say 300K. Typically,
3%.
you'd have a little bit of an annual increase in there. So we'll say 3%.
Let's say, is there a way to, let's say I'm a doctor, for example, and I know that in 5 years from now, that's going to take like a solid jump, 150K jump. Is there a way to factor that in just yet, or is that a new?
Yeah, you can. So if you wanted to fiddle around with like the leave periods, if you want to call it that, or adding additional income at certain points in time, you can also change savings rates, which is one of the important ones. I think if you want us to try and pump through this, I think we'll just stick to the
Yeah, we'll keep it
8K.
simple.
But yeah, you can literally change basically anything in the system is all a bit, you have the ability to change at a point in time, which is really powerful. For
Yeah.
example, rent vesting, or you own a house now and your savings rate's $2,000. In 10 years time, you want to rent vest and you want to adjust your savings rate at a point in time, you can do all that sort of stuff. It's very
Nice.
flexible. So in terms of savings now,
Let's say 100K and 8K,
100K is your total savings,
and let's say 8K a month.
8K a month, or good savings rate. Yeah.
This is not real for me, bro. I'm actually
That's
spending like
right.
crazy.
You want to start with 100K?
Yeah, start with the 100K and 8K. I feel like if someone's on 300K a year, 8K a year is around, or maybe let's make it 6K. So he's saving around 70K out of his 300K salary.
Yeah. Okay, that's fine. Yeah, so with a 3% annual increase. Now, we really looked at what we need to try and model out. We've tried to keep these assumptions to a minimum. Like we do not want to be putting crazy amounts of information in and making 25, 30, 50 assumptions. It just doesn't make sense. The idea here is that we can really identify opportunities. For example, do you purchase one property now or two? by splitting the amounts, that sort of those conversations that we regularly have as a buyer's agent, super, super powerful. But the savings rate here, the 6K, this is after everything. We don't want to know your budget. We don't care about that stuff. We just want to know right now, what are you actually saving net in your bank account per month after all of your living expenses and everything, if that makes sense. Okay, so now we want to establish your goals. Like, what is your goal in terms of replacing income? Now, we can go through this goal setting exercise, but basically, most people are saying, I want to replace my income. Now, you want to replace 300 grand gross a year. That's quite a big target. So what we want to do is we actually want to baseline and get these people down to like a realistic goal, because quite often you won't have a mortgage anymore. You're not going to have school fees anymore. You're not going to have childcare. By the time you retired off your portfolio, a lot of those things would be gone. So what we've done is we've created a goal setting tool. This is really powerful. A lot of buyers agents are using this tool like every day, to be honest, because it's quite powerful how the mechanism works. So
Especially with everything on social media these days, it's like replace your income in 10 years. It's like, bro, like you gotta, how much capital do you have to start off with to replace your income in 10 years? You know what I mean? It's not as easy, especially if you're just going clean buy and holds, right?
yeah, yeah,
I'll
100%.
almost say it's close to impossible, right? If you're trying to replace your income in 10 years, unless you have a very low income.
Yeah, and I guess one of the things I want to highlight here, and this is just something to think about, and I'm happy to do walkthroughs for any of you guys that are attending tonight, and run through your like how your business operates and what's relevant to your business as well. But I just want to highlight something here. We actually use net numbers, and the reason why is because gross doesn't take into consideration the tax event. So I just want to highlight something too, and I think I've showed you this before, Arshad.
Yeah.
If you have 100 grand annual income gross and then a 200 grand income, two separate parties, you're actually taking home 217,000 net, but it's still 300 gross, right? Now, if we get rid of one of those, so that was 217. Now, if we get rid of it and put 300K in here, in one person, it's only 192. So the
Mm,
importance of structuring the portfolio correctly to actually hit
mm,
your goals, it's far easier to hit a goal when you split the income, right? You're lowering the tax burden. It's a very, very powerful mechanism, and just something to think about. Our goals should not be gross. They should always be net.
Yeah, I feel like gross, like whenever people talk about gross goals, they're just doing it so that they can sell the client like a higher number. It's like, look, 500K, it's like, but how much are you getting taxed on that if it's structured ineffectively?
Yes, yeah, exactly. And that's where the tax consequences are very, very important when you're advising people is like, just you're not a tax advisor by any stretch. However,
Yeah.
this is a conditioning tool that's used to really establish a baseline, on basically what they should be needing to achieve, which is generally lower than what they think they need, which is great for you and trying to hit your goals, right? So you said the savings rate was 6 grand. If I said to you today, your portfolio is going to mature and you're going to retire tomorrow, right? On from your portfolio. What we're really looking to do is adjust your lifestyle or your goal so that it covers your whole lifestyle and all your expenses. So you're living off that, right? You don't need to save 6 grand a month at that point.
Yeah.
Makes sense. You've already catered for everything that you possibly could spend, and lifestyle adjustment.
Saving for retirement, right? What's the point of retiring and then
Yeah, correct. So this
saving?
this is actually a temporary expense. We don't need to save 6 grand a month anymore. And this is what people don't realize is like it's quite powerful. Now, I want to wipe this off and get rid of the mortgage because we're not going to put a PPLR in this instance. Somebody might have a nice BMW or something to $1,250 a month, and then they might have $2,000 worth or $22,000 worth of school fees, or even more. To be honest, it's crazy how expensive some of these things are. Now, one of the really powerful things here is if you look here, we've got total temporary expenses 123,000.
Mm,
That's money coming out after tax out of your pocket that you're spending. Those things will go away. So
mm.
we don't need to replace our 300 grand income because you can see clearly that we're spending money on things that are going to go away. So it's very powerful just to think through this process and understand what are the actual goals. And 9 out of 10 people don't know their goals. Let's be honest. So rent vesting is a really big thing, a conversation piece. So in this instance, we're renting now and renting forever. We currently spend, say, $600 a week. If we were to work into our or move into our ideal property that we're going to rent first now, what would that cost be in today's dollars? Just put in, say, I don't know, say $1,100 a week. This just does an adjustment to what your goal needs to be, so we can just cover your lifestyle expenses basically, and your living expenses. Does that make sense?
Makes perfect sense.
So, like for example, we're now spending an extra 26K a year on top of what we currently are. So we've just basically taken the temporary expenses off and then added an additional housing adjustment on there. So our baseline living expenses, we started with 192,000 net. We're actually only living off 95 grand.
Mm.
It's quite powerful to understand that these things will go away. So I'll keep going, and we'll adjust the lifestyle as well, right? So this is nothing to do with financial advice. We just want to know, if you were retired today, do you have any other income streams that are going to come in and offset your property goals? All we want to do is establish your property goals. Let's just say, no, we don't. And then future active income. And this is something people don't think about. Would you actually want to retire tomorrow if you could on a portfolio? Most people say yes, but the reality is you might be doing, $5,000 worth of consulting a year because you get bored. We want
No
to,
one actually wants to fully retire, you know what I
yeah,
mean?
if you retire at 40.
Yeah, like everyone, especially like, these days, you still want to be doing something, just something more interesting.
Yeah, 100%. And so the big one is like, what are you going to do? If I said to you, your portfolio is self-sustaining, you've hit your goals, we've lifestyle adjusted it, what would you want to do? A lot of people would want to go on a holiday or whatever that is per year. You just put the adjustment in, to be honest. Now, this tool doesn't have to get used for every client, but it is very powerful, makes your client think. You're working for your client, you want to add as much value as possible. And we
Yeah,
really want to pull their goals far more achievable so they realize they are achievable.
yeah.
So we go next. Now, this is really powerful, right? We actually need $110,000 net, which is 151,000 gross. Now, we started with 300K. We only need 57.5% of our current income to rent vest and upgrade our lifestyle, plus go on holidays. Do you see how powerful that is? Like, you don't need to replace your income. Your client needs to understand this. So
Yeah.
it's one of these tools that we can use to get them to a realistic number. Now, what are the portfolio requirements? Based off these numbers today, if we had a 5% net return, you only need 2.217 million in unencumbered assets with a 5% net return,
Mm.
right? Now, that's obviously a lot. It's not, by no stretch is that a little amount of money. However, in the context, as we all know, of building a portfolio, and we can get some very crazy results, and using high pressure markets and investing well,
Mm.
we're doing the right thing by our clients. At the end of the day, this is very achievable, and you need to make sure it seems achievable, right? Um,
Exactly. Yeah.
and does that all make sense?
Yeah, no, I think this tool specifically I've used it well for clients who have, I think for two types of clients. One, clients who have unrealistic expectations, where they come in and they're like, Arshad, I need 300K net passive income in 10 years. I'm like, bro, like, what do you want me to do? You know what I mean? Start a drug empire or something like that. It's not happening, right? Especially with your current income. So you can kind of like sit down and take them and make them run through more reasonable goals, right? Number two, I find this tool is really solid for clients that don't have goals at all as well, right? And in all honesty, I've started doing it with every client, but I feel like with those two clients, that's where it helps the most. The
Yeah.
clients that already have reasonable goals, right? They're the ones where this just kind of, I guess, adds an extra layer of confidence in their goals, right? It gives them that certainty. And I guess for you as a professional, it shows them that you're thinking through the details. You're not just here buying a property, move on, like, see you later. And the best part is like, honestly, it's like all of this you can do in 1.5 hours. And it's so much additional value and confidence that your client has in you, right? Just for that 1.5 hours worth of time. And I think like it also saves you time, because if you don't do this, they'll start to ask you all of these questions later, right? Like, I don't know how other people manage their clients, whether it's a WhatsApp group, an email thread, Slack, whatever. When you don't do these onboarding strategy sessions, they're just constantly spamming the group with random questions, right? It's like, what do you think a good goal is? Can I reach 150? Can I reach 180? Should I save this amount? Should I save that amount? It's like, one, we're not financial advisors, so there's only so much that we can say. Number two is if you've done this, you've already covered it. You front load all of the questions, right? Anyway,
Yeah.
let's carry on. So
Yeah.
that's goal setting, liabilities.
Liabilities, this is just a borrowing capacity, using the calculation for borrowing capacity. We don't care about payments. It's more or less, it's going to hinder your borrowing capacity. Put the liabilities in if you've got crazy liabilities. We just want to see it so we can adjust our numbers. Now, and then we go to assumptions, right? So the assumptions are by far, one of the most important parts of this. But what we're going to do is I'm going to set up a scenario now. So before we even touch this, we will change them in the scenario. So basically what we're looking at here, right, is the fact that we now want to build a forward-looking plan. Now, we're currently in our actual portfolio, but we want to build out a plan and say, look, this client doesn't own anything. Let's just add some properties to the mix. We want to show them what the actual cash flow consequence of this property we're purchasing is. Let's do it. So we go to scenarios, and because we've upgraded them to advanced level access, we can make as many scenarios as we want. Over time, you'll add to it. You might add, delete some over the years.
From Anik to host and panelists. Thanks, Arshad and Josh. This tool looks good. I have to jump onto another meeting.
All good, man. Thank you for attending. Yeah, so we're just going to create a scenario. Now, what do we want to call it, Arshad? What are you trying to do? Get some resi properties?
Yeah, so let's say the portfolio that I want to build is I want to, accumulate for 10, 15, maybe 20 years max, go hard on residential. And then once I have enough residential to hit that 110 to 150K net passive income, that's when I'm going to start to sell off the resi properties and transition into commercial. That's, let's say that's my broader plan.
Okay, so awesome. Well, let's just go accumulate resi plus commercial. Look, there's three options here just for clarity for you guys. Normal portfolio is what it is. It's actually your normal portfolio. We have SMSF and then we have merged. We won't touch merged today. Merged is basically you've got an SMSF portfolio, you've got a normal, you can combine them. So you can run a multitude of scenarios in each instance. So normal versus an SMSF and merge any combination of those portfolios together and see what the outcome is, which is pretty cool. But we're just going to stick with this. So what we're doing here is we're actually just duplicating the actual portfolio that we set up. So in the instance that we just did, we actually had no properties. We want to duplicate it and then build off there. We can then duplicate actual scenarios we've built as well. So for example, I just purchase two resi. Do I purchase another two resi or do I go commercial? You can run that scenario if you want. You just copy it again and continue. So now we click on this. And the one thing here is that we've now in a scenario mode. This is just like, let's go for it. Let's add some properties. So one thing to highlight, we've obviously added in all this information. It's copied across. So we've got our goal and everything there because we just duplicated it. Now we're going to assumptions, right? DTI of 6, let's just leave that there for now. We can override any broker calculations that they tell you you can only purchase X. We just do that. We can adjust it on the fly. You want to put your buyer's agent fee, whether it's percentage or fixed amount.
Honestly, this has been so good, this buyer's agent fee, because I've done a couple of I wanted to trial it out where I did a couple of sales consult for really warm leads. And these were I usually wouldn't go through this much effort for a lead, but they were high net worth. And when you're planning out their portfolio and you include buyer's agent fee and they see that doesn't make any difference.
From Andy Kota to host and panelists. Can we customize this to include other asset classes when building overall portfolio or just properties only?
Sorry, well, I don't know what this thing is.
That's okay.
Really.
Just on that note, we're property centric. You can take cash, like if you sell properties, you can actually take the cash out of savings. That's a financial advisor's space. This is really just for the property side and building a portfolio.
Yeah.
We obviously don't want to toe the line of financial
So sorry guys, just one thing, when you're messaging or if you have any questions, maybe just drop them in the Q&A. This chat thing is doing this weird thing where this lady is reading the questions to us. It's a little bit it's a little bit jarring. So if you have any questions, drop them in the Q&A. And I think we don't have to, I guess, hear that AI voiceover. Yeah, but I think like Josh said, can we customize this to include other asset classes when building the overall portfolio? I think for now it's just property, just to toe the line from a financial advice perspective. Is that correct, Josh?
Yeah, so like for example, if you sold a property and you want to use 300 grand of that for other asset classes, what you do is you basically you're more or less taking the cash out of that bank account that you either we've got the sale proceeds there, all the tax calculations done. You take it out, so we're not modeling. We only want to allocate the funds or savings that are applicable to your portfolio, and that's like a financial advisor's piece. Now, are we going to integrate with financial planning software? Yes, is the answer. However, when that time comes, we can notify you guys. So this is all property specific. Yeah, property centric advice is
Yeah,
what we're after.
nice.
I'll keep going, Arsha, just so we can get some properties in. But look, these are flexible. So if you're percentage based, or if you get fixed 15 grand, your sell costs, you obviously put in 3% or whatever you want to do. Now, this is the important part, this bottom section. This is the LVR settings. So yes, you can purchase at 97% and LMI is incurred, and it calculates the apportionment of LMI. This is for the equity extraction limit. Now, talking to a lot of brokers, and there's been a lot of brokers that have actually had a hand in building this software. Realistically, you're not going to be extracting equity up to 97%, nor should you be doing that from a structuring and risk management point of view. So you can go up to 90%. You can purchase at higher percentages, but just for equity extraction, it's limited to 90%. This is defaulted at 80. I don't know if you saw me change it. I typically would change to 88% for like running a session. Just gives you a little bit more flexibility, and it limits the LMI. So in terms of setup, yes, I've talked a lot. This actually takes about 2 minutes. Particularly if your client's already set up their actual portfolio, it's more of an audit. Having a quick look at the information, making sure it's up to date, and then off you go to the races. So as you can see here, I started doing some calculations already. But in this instance, Arshad, what I want to say is this 28 grand here, that was the car loan that we put in the liability section. And that is why that is actually there. So if the numbers ever seem quite off and you have large liabilities, the liability still does count towards total debt, right? That's not property specific debt. Just want to make that clear. Now, we want to add a property, Arshad. So one thing to consider here is, what's your borrowing capacity? What sort of property purchase are we looking at? Now, we did start with a small amount of savings. So let's just go and add some property. So we're going to go property one.
Or maybe let's increase the savings, because I was gonna say this person has a PPOR with some equity, but since this person doesn't have a PPR with some equity, let's say they have 240, I was gonna say 300, whatever.
Yeah, whatever, man. Let's go. Or whatever you reckon. By way of example, it's the same process. It doesn't actually make any difference. So this means you can buy more properties, right? Now we're going to add property. Pretty self-explanatory. Add new property. Now we're going to give them a nickname. One thing to consider here is that we want to give them a name as how they fit into the cycle, and we are doing a daisy chain of events here. So basically, what it means is you don't just purchase 1, 2, 3 properties and go and stick a property in halfway through those 3 or 4 purchases. Have a think about the order of events. Makes a big difference. If you're purchasing in the immediate couple months, you might know the state and suburb, but if you don't, it doesn't matter, right? Now, selected intended hold period. This is something just to think about. It does work with other integrations that we've got, and can like help you shortlist suburbs. However, just something to think about. So I'd say like over 7 years for this property. We're building out a robust portfolio. Now, the property type, residential, we can pick from a multitude of different property types. Obviously, that will come in at a later date, as we've discussed. Now, we do support individual name, trust, and company. We're not going to go too hard into this tonight, but you can, manage your borrowing capacity by excluding trusts. It does tell you the self-servicing status of trusts and companies if you want to use that technique. That is something that we do support, and it is super accurate. So, if you want me to go through that in greater detail, I can run another class or do a walkthrough for you.
Yeah. I think the trust buying component is really cool. I don't know if you have time to go over that today,
I'll
but
see if I can do a trust purchase in this. So I'm going to start getting the wheels moving pretty fast now.
yeah.
Uh, as I said earlier, if you've got multiple members of the portfolio, you can split it and apportion it. Jan Jones or Arshad in this instance is the only owner, 100% ownership. Let's continue on. We support principal place of residence and investments. This is an investment property, so we're just going to continue. You can change the use over time, and the 6-year rule will come in if you understand how that works. All the calculations are done in the background. So what we're going to do here is we've got our borrowing calculation here. This borrowing power optimizer really comes in when you've got trusts and companies. It will show you what trusts have what properties and what their cash flow looks like, which I'll show you shortly. But yeah, we just continue on. It's very much, I would say, follow the bouncing ball. We just want you to follow and just input the information. You can punch these out really fast. Now, what sort of purchase price are you looking for, Arshad, in this instance?
What do you think with $1.7 million of borrowing, maybe 650? We'll get the first one done, 650, 700, and then
Yeah.
keep at a maybe make it three up, 2 to 3 very quickly, and then
Yeah, so what we'll do, and again, we don't have any equity in this instance, so obviously we're using a cash deposit. We've got approximate purchasing costs. We put our buyer's agent fee, essential. This is really, really easy to condition clients in terms of the fee. Like Arshad said, it actually doesn't really make much of a difference in the modeling in the wash, and it's very, very handy for just put it in there and say, look what the results we got while that was in there as well. It shows you, it always has helper text. So no equity can be extracted from other properties. Awesome. We need $135,250 to complete. Now, this is the important piece here. I just want to highlight that you should be maintaining buffers all the time. So we've got 170K buffer here. I'm comfortable with that in this instance. So we're just going to continue. Now, the way we've set the loans up, we can actually invite a broker in and it shows you what's secured against what property. We can extract equity from properties, and I'm going to show you that in a sec. But we're going to go for an interest-only loan in this instance, Arshad. For the purposes of modeling out, what I use typically is a loan term of 100 years and an interest-only period of 100 years. And I'll explain that in a little bit more detail. So if we put in a standard interest-only loan, say 5-year interest-only period and 30-year loan, you have to refinance that every 5 years. You can do that if you want, but if you're putting multiple purchases in and you're going to refinance it to interest only every 5 years,
it's going to take so much time.
It just takes a bit of time. So this is the exact same.
It's just basically like once the interest only period is over, you're just moving it to a different bank, and it's just pretty much interest only until you eventually sell the property.
Correct. Yeah, and it just makes the modeling look a little bit smoother on there. It's not going up and down, and it just is a little bit more fiddly if you're going to do it accurate. However, it does serve a purpose, and it's very, very important when you're showing someone the differences between if you went P&I and interest only and the effect on your portfolio. Like you see the reversion to P&I, and they go, "Oh wow, I want to stay interest only." So there's a few things there, but yeah, 6.09%. Let's just continue. Is very straightforward. Now we've adopted the property value in this instance of 650K. We're now going to add some growth periods. Now, I don't like using static growth periods. Let's just assume that we're going into a higher pressure, warmer market. And I think we, potentially could start at say a 6%. Let's use an 8%. Have you got any recommendations here, Arshad?
Yeah, I'd even put it more at the beginning. Maybe go like 10% the first year, 12% the second, and then go ongoing 6,
Okay.
ongoing 5 maybe.
Yeah, that's
Whatever.
fine.
Yeah, it doesn't really
Yeah,
matter.
so the importance here is that if you get a 1 or 2% deviation at the start of front loading it, it actually makes a big difference to the modeling. So
Yeah.
just have to think about where you're purchasing and the intent, and then we can keep.
Bro, these days you buy, it's up like friggin' 20% in 3 months, man. So,
Yeah. I mean,
yeah.
and you can play around with whatever scenario, and you can run these scenarios against each other. If we got 10%, 5%, just duplicate the scenario and change the growth rate. I can show you how to do that. But what sort of yield we're looking at? Say a 4%.
Let's say 4.8%. Let's say 4.8% on a 650 purchase.
Buyer's agent. Yeah, we got 600. That's $600 on the dot. Rental growth rate 3%. I don't typically change this. Now, if you're adding in an existing property into a tracker, this is really relevant. You want to sort of see your cash flow statement.
Yeah.
For this instance, we're going to put in the total expenses. It's individual name. It's probably like 9-10K annually, to be honest,
Yeah.
of other ancillary expenses. Expense growth rate, you can play around with that. Typically leave it at 3% and continue. Depreciation, I just want to highlight the importance of not going crazy on depreciation. Many people don't understand that it actually gets added back when you sell. So if you put in, and I had a few buyers agents put like 20K a year in. Now that's great if that's legit, but for the purpose of modeling out, you just keep it to a minimum.
Mm,
And because it might change your cash flow situation, which is
mm,
great. We really don't want to overstate it and then tell a client, hey, this next purchase is, unless you know the information,
mm,
just leave it zero or $1,000 or something like that. You
mm.
don't know the property you're purchasing at this point in time, right?
Yeah.
Okay.
And you always like, and when you're doing the tracker, once you've bought the property, you get the depreciation schedule, then you can just add it in there. Yeah.
Yeah, so the cash flow here is saying $1,209. So I just want to show you something. We go to the cash flow statement.
Mm,
We've obviously got 21 grand in total rent, 13 grand. Now, the reason why it's so low in the first year is because we don't calculate it on a calendar basis. We calculate it on a financial year. We're purchasing this in a month's time from now.
mm,
So it's actually prorated to the date. I just
mm.
want to highlight that. So when you're looking at, you want to identify what the actual cash flow looks like on the chart. We're going
Yeah.
to use our equity cash flow changer, and we're going to get rid of our goal. And this is actually what the cash flow looks like. Now, one other thing here, which is really powerful, is we're running 100% offset in all these instances. If you have not got this $219,000, can you see this here?
Yeah.
In your offset account at this point in time,
Hmm.
and it was $0, the cash flow is actually like this yellow line. And
Yeah.
this highlights the importance of using offset accounts where applicable.
Mm,
We're going to actually add an extra line in that tells you the cash flow without an offset account. That's coming
yeah.
shortly. But one
Yeah.
thing to note here too is all of these things underneath give you all the information you need, and it's all dynamic. As you can see, the cash flow is changing. Um,
Yeah. To that particular financial year, right?
and we just stack properties in. Now, what I've actually shown you is everything, to be honest, in terms of adding properties. So what we really need to do now is just identify when's the next opportunity to purchase based on borrowing
Yeah.
capacity, based on how much we've got in the bank. And then we just continue building, and we'll no doubt hit a roadblock at some point. We will
Yeah.
that roadblock.
One of the talking points, I was having this chat with one of my doctor clients. He's like quite high income, and we were talking about this idea of like how often should he purchase, right? And
Yeah,
to me, I was like, look, if you're in the accumulation phase, right? If you have the borrowing capacity and you can manage the cash flow of an additional property, then there shouldn't be anything else that stops you. You know what I mean? Like those are the only two things that can stop you. And I think like a lot of clients, they come with this I guess like they say this phrase. I don't know if the other people in the chat or other buyers agents have had this experience where it's kind of like, oh, I'm not ready for my next purchase yet. And then you ask them, what do you mean by I'm not ready? And they're just like, oh, I've just got a lot going on. It's like, what do you mean? Like, we're going to be doing all the work for you, right? So it's like with this, you can kind of like show them the power of making that purchase happen earlier, right? You can show them the cash flow, show them the equity it'll create. And then you can kind of, I guess, uh, talk to that point of I'm not ready yet when there's nothing that should be blocking them. They have borrowing capacity. They have uh, they have the ability to manage the cash flow, right? I think that's what this cash flow
yes,
threshold thing is,
yes. I
right?
want to explain that. You've basically, and this is very, very powerful. So we put in a $6,000 savings rate. That's what
Mm,
we put in, right? So if you said what 6 grand a year, it's $72,000 worth of savings a year net, right? Now,
mhm.
what that's effectively, is that right? I think that's, yeah. So
Yeah,
basically, what that effectively is saying is that with our savings rate, if we take that as that's our maximum hurt. Like if we were to use all of those savings on additional purchases, that would stop. Like at that point, we would be going into the red, right? Would be really hurting once we get exhaust all of our additional savings. So that's basically what this line represents, so that you can show people, hey, wait up a second, you actually have so much play from your the savings rate you've inputted really is highlighting that you've got multiple extra purchases here. Now, can you make those
Yeah.
purchases? That's a different question. It comes down to serviceability and borrowing capacity. But like here, you can really see like they're not even
Yeah.
in any way, shape, or form.
Yeah. What I tell them is we don't want that red line to drop below the blue line. And in most cases, the red line doesn't even come close to the blue line, right? So it's like cash flow, which is almost never a blocker. It mainly becomes borrowing capacity that's the blocker, right? And that's where I guess
Yeah,
you
yes and no. If they have a really low savings rate, it's obviously you need to manage the cash flow better, but that's what it's here for. Is it might mean that you have to wait longer because your savings rate, you need to accumulate A, more savings, but B, you just want the cash flow of the property to increase a little bit before you go into a subsequent purchase. It's just managing that, and it's really easy to manage and it's graphically there. But one of the things that I want to highlight in that instance, Arshad, is like if that red line's going below this blue line, right? You might have 200 grand in savings and it's only for 1 year, it's going down 5 grand, right? Underneath that line. You can weather that storm. It's just how you manage it. So if you had zero in savings, then obviously that's really bad. You don't want to put yourself or any client in that position. But if you're looking from a strategic point of view, there might be some instances that you're like, hey, for the sake of 1 or 2 years worth of declining cumulative savings, yeah, it's a bit of punishment, yes, but I've got heaps of buffer, and that's where the savings buffer comes in. So, a lot of strategists talk only about savings buffer. We want a dual pronged approach. We want cash flow is oxygen. You need it to survive if you don't have cash flow. And technically, if you play the lender game well, you can actually overstretch yourself, and you really don't want to do that. So we just want to manage it as best as possible, and that's what this is here for. Um, Now, in this instance, I'd like to say, like, let's try and buy another property as soon as possible, see what we can do. Just
Yeah, so let's say Jan, myself, we're aggressive property investors. Our headspace is as soon as we have the equity, we want to go again.
so you want equity, use equity.
Equity, cash, as soon as we have borrowing capacity, let's go again.
Yeah, okay. So you've got borrowing capacity already. So let's just go May next year. Let the dust settle on this one over Christmas. We'll go individual name again, and we're going to go Jan Jones investment property. And as you can see, I can fly through this pretty fast now. So we still got 1.4 of borrowing capacity at this point in time. And the reason why there is that we actually the cash that's coming in from the properties is also propping up your income, right? Now, I want to show you something here really important, really quickly. This little pencil next to available borrowing. If you are purchasing immediately and the broker says you can borrow 800K, but the system says, say, you can borrow 600K, just change it. And I want to highlight that because this needs to be broker driven. You shouldn't be restricting what you can put in the system because the system says based off a DTI. And that goes both ways, right? So when you're doing trust lending, you might say, look, the broker said that I can't borrow 1 million. The system says 1 million. I can only borrow 850. Change it to 850. We don't want to skew the modeling. Put in exactly what you think is applicable and even downplay it as much as possible. So you get really conservative results over time. I think that's really important to understand. This broker override feature is super, super handy. All right. So basically, Arshad, at this point in time, we don't really have a whole lot of equity, but we still got 210 grand of savings. So I'm just going to keep purchasing and then we'll kick on with the equity, right? We still got a 75 grand buffer. So we're going to continue. Now, principal and interest, we'll go interest only 100 years, 6.19%. Hopefully we've got some rate cuts before then. Continue. And now we're going to put in the similar sort of growth rates. I'd assume that that's about right, is it? 5%.
Yeah, and then 5% ongoing. Done. Yeah.
And then what sort of a yield? Same sort of yield, 4.5%.
Yeah, let's say 4.5% for this one as well.
Yeah, $463 a week. We're going to put in the general expense breakdown. Let's just put 10K. Let's just say it's in Victoria, for example. It's expensive. $1,000 in depreciation. Now we've added our second property. As you can see, it's all dynamic. We're changing as we on the fly as we go. The one thing I want to highlight here is that it's literally follow the bouncing ball. Just add a property. When you hit a roadblock, that's when you'll identify. In this instance here, the cash flow is now starting to get negative, and as you can see, this is peak negative cash flow. I want to highlight something very important. We also talked about net at the start of the conversation. This is net and it's distributed based on your income. So if you look at the cash flow statement, it's obviously got gearing benefits here. So, your total before is actually negative 21, but you got $10,174 back because of all the deductions that we had on the property. So it calculates it as if it's a tax return and fully itemizes it if you put in all the expenses. So
Yeah, there you go.
this is actually what it's going to cost you based off your financial information that you put in. Does it make sense?
Yeah, and that's including the money in the offset, yeah?
Yeah, so it's the actual cash flow. Yeah,
Yeah,
100%.
nice.
So, and
Can
we're
we go to the equity side of things as well? Have a quick look at that. The equity
Yeah,
sheet,
so like the equity, sorry, where?
the graphs.
Oh, sorry, yes, yeah, yeah. So this is quite powerful as well. When we're using trusts or companies, one thing we want to highlight is that you can exceed your borrowing capacity, your standard threshold for borrowing capacity. This is another great check. How much how much do I have left in the tank if I really want to try and stretch this as much as possible? How much do I have left in the tank? When you've got trusts and companies, you can actually get past this DTI line by getting a little bit creative. But yeah, this is the equity chart, and as you can see, we're trucking along pretty well, and the numbers are all dynamic here. So we can say like starting to get
Let's click on FY40, for example, right? So just with these two properties in FY40, the equity is 1.8 million.
yes,
Yeah, nice. So it's like you can even just show your clients, like, look, let's say your client has let's say your client's goal is, I've got a 2.5 mil owner arc, and my goal is to pay that off, right? You can show them in 10 years, you're going to have 1.3 mil equity. You can pretty much pay off almost half of your owner arc once you sell down the properties or whatever
yeah.
it is,
So
right? And that's just two, right? Two is conservative. Want to keep slapping another one on top whenever we can.
yeah, so one thing to highlight and what you said is really, really powerful, very underutilized sort of strategy is, and I'm getting a few questions around this. I made these up, but basically sell all excluding PPLR. Now, what this actually means is something you just mentioned is if you had someone with a PPLR and they want to pay their house off, right, how long is it going to take to pay that house off? Right. So what we've done is we've created these two metrics here that sell all excluding PPLR means we're going to sell all our investments, which in this instance, we don't have a PPLR in the system. If we sold these two investments at whatever point in time, this is how much is going to be net after capital gains tax and everything in your bank. Now, there's two reasons why you would use this. One is so that you can identify an opportunity if you did want to transition to commercial or something like that. You can use that as a very good point to say, look, I'm going to have $1 million in the bank in FY36 based on the assumptions I put in. Yeah, I reckon around then is maybe a good time to transition. Up to you what that point is. But I want to highlight the one below. So PPOR surplus and deficit, the intention here is that we take into consideration your PPOR debt. So it's very similar. And the only reason why these are the same numbers is no PPOR. Now, what I mean by this is, let's just say you had a 600 grand PPOR debt at this point in time. The positive number would be 400K. Now, as you wind back, once it hits zero and it's a positive number, you effectively could pay your house off. So this is extremely important when you've got a PPLR and someone says to you, hey, I want to purchase one or two properties to pay off my house. You can literally model it out and go without doing any selling in the system and go, hey, in FY33, you're going to have enough. You're going to, if you sold your properties that are investments, you could pay your house off. We've done all the calculations in the back end. It's like super accurate. So very, very powerful strategy. If you've got clients that, not everyone wants 10 properties. There some people just want to pay the house off. And I think that's the biggest opportunity in the market at the moment is actually investment to pay off PPLR. So yeah, super powerful. Let's add another property if you're keen.
Yeah, let's do it, man. Uh, I'm an aggressive investor. So when can we add the next one? Can we do it immediately, or do we need to wait for some equity?
Let's just have a look, man. Like right now, if June 1st, 2026 is right there, we've still got some borrowing capacity. We've got hardly any equity at this point in time. We're still waiting for it to accumulate. Now, what I want to highlight here is that let's fiddle around with the dates here, man. We've only had a few months between purchases, right? There's like really not starting to
Yeah.
die in time.
Yeah. So let's move the purchase to like late 2027. Let's say October 2027.
Okay, cool. So
Right?
probably
So
uh,
probably has a bit more savings now and a bit
yeah,
more
there'll be a
equity
bit
as
of, there'll
well.
be a bit of equity. So we started low on the 185 grand. It's not too bad for a year's worth of for investing. Now I want to show you how to use the equity pretty quickly. I know I talk a lot and I apologize, but let's just go for what a 700K purchase. Now you've got 160 grand in savings. You've got 185 grand of usable equity. We want to preference using equity, high deductibility. So what sort of purchase price do you want, Arshad?
Let's say again, yeah, let's say around that 700K mark, 650. Let's go 650 again. 700, yeah.
Yeah, sweet.
Yeah,
So
either way is fine.
we talk a lot, use a buyer's agent. Now we want to use equity from other properties, and the max we can extract is 185K, right? So basically, what we're going to do is tick that box. What do we want to, which property do we want to take the equity out of? Let's just use property one in this instance. Now, one thing to note here is that we are actually assigning an equity loan to the property one in the system. This is very powerful because then we can get the cash flow accurate. So we're not just extracting bucket loads of equity unnecessarily. We want to be as accurate as possible. Now, what I want to show you here is that we are now adding an equity loan to property one. If you could see there, at it, we have 125 grand available in property one. If you had a PPOR, you always want to preference your PPOR. The reason why is the debt recycling and making your PPOR deductible, like deductibility on your PPOR. It really speeds things up for your PPOR payoff. So we go interest only. Let's just say 125K in this instance was the max we can extract is 125,900. And let's just go 6.19%, 100-year loan term, 100-year thing. Now, we've just used one property in this instance. We've got 10 grand left to do. Are you happy with that, Arshad, if you spend 10 grand out of your pocket?
Fine.
That's fine.
Yeah, gotta make
We've got a good
it
savings
work.
buffer. We continue. So again, we really want to just hone in on it gets quite fast when you nerd out on it a little bit. Now, I think we need to start cranking this up. We'll run with the same philosophy here. Maybe 8.5 and save and continue. What sort of yield are you looking at? Same thing, 4.5.
Let's say this one we get something high yield. Let's say we get like a 6.2% yield one.
Now we're
Something
talking.
like a deep or something.
Yeah,
Yeah.
dual continue. Let's go 12K for expenses. We're always making sure that we're a little bit overs on the numbers in some instances and unders on the others. So this is all hypothetical, and that's why it's important to understand. Now, our portfolio value is obviously cranked up here, but we really want to stay in the cash flow chart. And as you can see, as we hover over the significant event, which is a star, it shows you when you've purchased properties. So in this instance, we've purchased two within that space of time. We've got the two properties here. Now, this is starting to get pretty interesting because, as you can see, we haven't really hurt our cash flow too much because we added a high yielding property at 6.2%, right? So
Mm.
as you can see here, we're now going to, and this is the importance of rental yield. I just want to stress this. Buying properties with a high rental yield from the onset is great if the fundamentals of the area support the growth. That's one thing to consider. If there's no growth and we just build out a cash flow portfolio, you end up with no asset base at the other end up in these years to convert to anything else. So just something to note there, that we really want to preference fundamentals, and then the cash flow is really important as well. Now, so look, as you can see here, FY40 was your benchmark before. We've really only increased our cash flow for about 5 grand a year from where we were before net. Not crazy cash flow, but that's not what we're looking at. What we're looking at here is actually, and this chart, I know you like the equity chart, but we can see the value, the total debt and equity here as well. As you can see,
Yeah.
really started dialing things in at this point in time, like 2 million in
And
equity.
yeah. And now it's like if he sells it all off at FY40 and buys a 5% net yield asset, he's pretty close to his goal.
Well, it depends on the numbers. Like it's obviously inflation adjusted. We're pretty far off here, but
Yeah,
In the
fair
essence
enough.
of time, like, but what we'd really like to see here is I'd be like ramming properties in here as much as possible and
Yeah.
rapid accumulation. This period in incubation in the center, that's great. But the incubation period, let time do its thing. Let the properties just grow in value and build that asset base. When you get to FY40, you then have so many options. You can keep them, sell them, whatever you want to do.
Mm.
We can run a scenario now that we sell, and I can show you that if you would like.
Can we just quickly add one more buy in FY33 or FY30, 32, and then we sell them all off in FY40 and buy a commercial and see
30,
what,
yeah.
yeah, 30, 32, whatever. Let's say we buy a property.
Yeah, so the one thing to note here is we've actually gone individual name for all of these. If we use
Yeah,
trusts and companies and granny flats, we can really dial this in. But just by way of example, we just wanted to show you how to add properties. Now we get 700 grand of equity, man. It's done and dial
yeah,
in multiple purchases. I'd suggest
yeah.
here probably maximizing the amount of available borrowing.
Yeah, so let's buy like a $1.3 million purchase. Like
Yeah, so like in this
is
instance.
that doable?
It's not at that LVR. So what we'll
Yeah,
do is
so let's
we'll start playing around with LVRs.
say 8%. Yeah, that looks good.
Yeah. So
And we
now,
got the cash to make something anyway.
yeah. So then in this instance, man, what's happened is we've stretched it so far. Yes, we've got usable equity, but one thing to note, available borrowing and usable equity, that's one in the same. You've got to borrow this money. So in this instance, I would suggest that we're now using a huge amount of savings. Do you want to do that? And that's something to consider. I don't think that's you would do that. You would probably want to keep cash buffers, but it's up to you. Now, noting this, there's only 10 grand left of equity to extract because we've maxed out our available borrowing. But again, we could say in this instance, the brokers said we can get 1.3 million if you wanted to, and you could use that if you wanted to, and then look at now we've got more borrowing. We can now extract 260K if you wanted to. So you can play the lender game as well if you want. What do you think for this scenario? Just use the standard amount.
Yeah,
Yeah. So I think we need to dial this purchase price back a little bit so we're not using all our cash. And we'll
okay.
we are a little bit, 83% or something like that.
Mhm.
Yeah, look, 137 grand, let's use it. Makes sense.
Done. Let's do it.
Let's just use property two now, and we're going to go interest only. Amount to extract is like 137, 6%, 100 years, 120K. It's a little bit more manageable. And the reason why is we're going to use this cash at a later date for this transition that we're talking about. 100, 6.19. This is all making sense. Let's just follow the bounce.
Oh my
Very, very easy. Now we're going to let's go 7%,
God.
10%, and then back. Let's do 5%. That's fine. Continue. What sort of yield would you like on this? 4.5.
Say 4.5. Yeah.
Just understand that when you're playing with yield, it does make a big difference. So we really don't overstate it just because you're getting a dual lock or something like that. Um,
Yeah.
make sure that if that's your business model and you go for dual occupancy, 100% do it. But don't always bank on the fact that that's what you're going to do. Now, crazy here, right? So we've got another purchase FY33, FY40 now. Look, our equity's dialed in. Once we sell all this stuff, we're going to have $2.4 million left. Yeah. So one thing to note here is that if we had $2.4 million, we're probably going to be able to buy like a pretty juicy commercial if that's what you wanted to do. So let's
Mhm.
like let's go for it. So we want to
Let's
start
do that. Yeah, let's sell it all off and buy that commercial in FY40.
let's start selling. So in October FY40, we're going to sell on the 1st of October. We're going to sell everything, right? Basically, it's done all the calculations for us. You can change the numbers if you want. It identifies a loan
Is
balance.
that ineffective from a tax perspective, selling them all in the same year?
To be honest, man, we've got such a capital gain and a high income that when you actually look at it, Yeah, there's no amount of splitting over years that's really going to save you in this instance.
Yeah, fair enough.
Like you know what I mean? Like if you have a
And
look
we don't have time to do that, so let's just pump through it. But something to think about when
600,
you're, yeah, go for it.
I don't know what's going on here. So sell property. Yeah, whatever the date is, we got to sell capital gains tax.
We got to
Sell.
move it to 2040.
Hey,
Sale
sorry,
date is wrong. I think you got to move.
you're right. I just being a bit. Okay, sale price will calculate. Now the total sale cost. Now let's just say it's 1.5 million. Let's just say it's 45 grand. Selling agents rip us off. Now we want a 604K. That's property sold. Now we want to sell off property that's already sold. As you can see, there's a sold banner on it, which highlights which ones have been sold. FY40 again on the first. This is why the sell all function is actually quite powerful, because when you're looking at the chart, you don't need to do the sell down. You know where you are at a point in time. Does that make sense? So now we're going to go sell property, FY40. Now, one thing to note when you're transitioning to a higher cash flow number, we really want to ensure that you've got a runway, 45K. We've got a runway of cash flow increasing if you do go commercial. So, for example, we really want to highlight the fact that when you're going into the commercial property acquisition phase, you're going to get a runway of cash
From
flow.
Richard B to everyone, what's the cost to subscribe, or is it free up to 10 properties?
What was that? Sorry.
We'll explain how the product works once we're done with all of this, Richard.
All right. So now, as you can see here, we've now sold off all our properties. We had a massive cash flow spike. We've sold them all off. Properties sold in in this financial year here. Now, what we want to do is we just want to have a look at it and say like let's go in FY41 and buy a commercial. We're going to go in FY, say like FY40. Let's just go December. Commercial. Residential, we changed to commercial. Let's just go. We want to purchase this in trust because it is a commercial. That's typically you would be purchasing in a special purpose vehicle, which is a trust. Now we click on the trust that we've purchased, and we're the beneficial owner. One thing I want to highlight here is that you can go and change your buyer's agent fee. I'm just going to leave it out now, just in the essence of time. For the commercial transaction, you would change your BA fee. Look at our borrowing, right? Over time, like we're talking 15 years down the road. We've got a fair bit in this instance, like in this year. So let's go save and continue. Now, because it's commercial, we've just dialed this right down to 70%. Right, we've dialed this right down. Now, what I want to do is I want to override this, and I'm just going to say we're going to use like a lease stock sort of function. So we've got $3.7 million worth of savings, which is insane. So what we really want to do is just level this out and say, look, we've got 3.5 mil of borrowing on this one. We tone it down, and the intention here is that you're never always going to have as much borrowing capacity when you're in trust. So just tone it right back. So let's just say we've got 3.5 million in borrowing at this point in time, and our cumulative savings is crazy, right? So you can start playing around with some pretty wild scenarios. We need 1.75 million, but really what we want to do in this instance is decrease the LVR, increase cash flow, right? So we still got $1 million in the bank. Like we want to dial this right down, and see what effect is this going to have on our portfolio. We still got 479K of buffer. So what do you want to do here, man? We can just keep increasing the.
Let's buy something. I reckon let's keep it like 4.5 mil. Like, what do you think? You're the commercial specialist. What do you?
To be honest, man, if we're going commercial, like you'd be going multi-tenanted, we could do multiple purchases. I'd say suggest doing multiple at this point in time. Again, one thing to consider here is that we want low LVR, we want cash flow. That's the idea of transitioning. So I'd be inclined to like go for a higher LVR, higher purchase price and a
Lower LVR. Yeah, I think a 5 mil, maybe even like, yeah, I think 40% should be good.
Yeah, you really like that's the whole idea. And then you've got a runway. So what I mean by runway, and I keep saying that and I haven't really explained it, the runway is if you're getting 3.5, 4%, increases per annum in rent, you want a runway of that. Like when you're going into retirement, you really want to for that to compound and increase, do its thing, and the cash flow just gets bigger and bigger and bigger year on year. So that 5 to 8 years is typically a good runway before retirement to let that transition happen, because by the time you hit retirement, like you've got the cash flow, it's even better than what you thought it was. We're going to leave this at 5%. We can get into a different conversation that commercial actually does grow really, really well, and in line with residential. There's a few different mechanisms as well with commercial, but I think that like a high fives, like a 5.75% net yield in this instance would be probably.
So isn't this gross yield that it's
No, so we can make this net really easily by not putting expenses in.
okay? So we just
Yeah,
put
yeah, yeah. So
dollars for
it's
expenses.
the expenses is what makes it. So one thing to note here that this is annual. It changes to annual by default automatically when we go to commercial, 287,500. Now rental growth rate. This is where you need to play around with some commercial. So I'd say 4% for some stock, 3.5 or 3. We'll run with 4. Total expenses. Now, very big misconception with commercial that everything is covered. Sometimes you have a land tax component that's not covered. It might not be a triple net lease. Let's just assume that there's like, you're going to at least have some accounting fees in this instance, and let's just assume it's a triple net for whatever reason. You still have accounting fees, right, per year for the trust.
Unless you get them to pay your accounting.
You can swing that, can you? Yeah, that's amazing. But yeah, like it's just something to consider. Save and continue. Now depreciation, just leave it. Now we've got the commercial. I want to highlight how much the cash flow changes here.
There you go.
See what I mean?
Honestly, when you show clients this like that, it really gets them invested in buying a lot of properties early on because you show them that long-term commercial jump and it's
100%.
like juicy, right?
And this is a very like we've just could have like just put this together. That's a rudimentary, right? Now, what I would say is this property here, we want to purchase probably another one and then pull this purchase in. The longer you have time to compound, the bigger the asset base, the bigger the property that you can purchase.
Yeah.
And
Realistically, this person could probably purchase another 3 or 4 throughout this timeline. Obviously, we
yeah,
don't have the time to put another 3 to 4 properties. It's already
now,
7:15, but they
now
technically could.
let's
Yeah.
let's just assume that the personal portfolio they might have had a property, right? Now, what we're doing here is we're comparing what they currently have, which I have nothing, versus what this scenario is. You can compare up to 3 scenarios on a cap equity and a cash flow front. This is extremely powerful, right? So, you get that fork in the road and you're like, oh, well, how the hell am I gonna like how am I gonna go forward? Should I buy one resi, two resi, 10 resi, one commercial, whatever the case may be? Let's just run the scenario, duplicate where you've gotten up to when you're at that fork in the road, like that, and say, look, let's just do this scenario, and you can actually nerd out quite a bit on it. It's like it's really fun to start playing around with different scenarios. But the important thing here is compare what they currently have. Like in this instance, the blue line is nothing, then compare it to like a scenario that you think is really good, and then potentially compare against a scenario that's like edge case that yes, it might work, it might not work, or potentially what the client thinks is right. We will figure out what the best course of action is, and that's like just that clarity. And when people visually see it, they go, oh wow, okay, yeah, I was thinking down the complete wrong path. It doesn't make sense. And quite often, if you structure the portfolio correctly, you can actually get to the same equity position, but you've managed cash flow, and then you end up dialing the cash flow in. So you're not at any less, not any less wealthy, but you've got heaps of cash flow. So then you've got options, right? And if anyone wants a walkthrough, I can give them a personal walkthrough as well. Happy to do it. But yeah, like it shows you the differences at each point in time, the best and the worst differences for cash flow and for equity, and then obviously over different time periods. Now, one of the things I want to highlight here, relatively complex, but this dip here, which is where people be like, oh, what's the dip? Um, you know, this is basically when you go into your cash flow, you want to identify what year it is, and just slide across, and basically you can identify exactly what's happening now. The reason why there's a dip is because it's based off financial years. And multiple things happened in this financial year. So we sold properties and we purchased other properties. So it's actually figuring out your true cash flow for that year. And that's why it's dipped down a little bit. You had a spike from your resis, and then you sold your resis, you had a portion of your year residential and then commercial. So there's nothing to be concerned about. It's just something to consider, that's why that's there. But yeah, like all, we're still not at our goal, but look how we're pretty close. One extra purchase and we would have been at our goal.
And that's inflation adjusted goal as well, right?
Yeah,
It's not even just,
yeah,
it's not even, and this is after tax inflation adjusted. So they
correct.
hit their goal pretty much around FY 45, 46. Like
Yeah,
it's
I mean,
explosive.
to be honest, man, like like I
Yeah.
said, if we put extra purchases in here, and then there's obviously cash flow goal met in this year, but if we put an extra purchase in there, we would have annihilated this. We would have brought the commercial purchase forward, and like very robust, like very simple
Yeah.
portfolio, quite boring.
And this is where you can, I guess, show your clients like 3 will get you to your goal in 20 years, 6 will get you to your goal in 12 years, whatever. And then you just need, and then it's just like, can you manage the cash flow, right? And then that's where you put in the cash flow threshold. Josh, could you just take that cash flow threshold thing? So you show them like, look, you're not even getting down to your cash flow threshold. So why are you being so, it's a way, I guess, to question the conservative nature
On
of
Tom to everyone. Hi Richard, the portfolio tracker is free $100 for advanced access pro tools, lifetime access to map out unlimited scenarios for your clients.
I have no clue when Zoom
Yeah, I
introduced
don't know.
this.
I've never heard that before. That's
I'm sorry, guys. I'll make sure this is fixed up for the next one. All right, we're in interest of time because I actually got a meeting after this. I'm sure you guys all got things to do.
yeah.
Let's jump to questions, guys. Can you please drop your questions, not in the chat, but drop them in the Q&A, just so we don't have to hear that thing again. Now, in terms of how Zapiio works is, and Josh, correct me if I'm wrong, is
Yeah.
uh, actually, before that, there's a lot of stuff we didn't go over today that the
Oh yeah.
tools, trust buying, adding granny flats, adding renovations, doing developments. There's heaps more stuff, but we wanted to keep it pretty clean, simple, and easy today. Right now, just like a basic portfolio, right? Now, in terms of the way that it works is if you guys have HTAG access, you have free access to the tool. You can upload like uploading portfolio trackers. You can
Yeah.
upload as many as you want for free. To do a scenario, you have to use 1 credit, and 1 credit costs $100. For the people who attended today, you'll be getting 1 free credit. If you
Plus the two, you get two included in the when you sign up.
to include it if you have HTAG or just for anyone.
So if you go through HTAG, you have two, and if you're not part of HTAG and you want to sign up, you can sign up directly, and you will get two when you do the
And
partnership.
how much does it cost to sign up directly if you don't have HTAG?
$850 once off for white labeling and partnership, and you'll get a walkthrough, 2 credits, but for you guys it will be 3 credits, which is 3 client plans. The
Yeah.
100
So
credits.
that's like 3 client plans. For each client, you only need to create 1 plan. You only need to use 1 credit, and then using that 1 credit, you can pretty much create an infinite amount of scenarios for them. Right? So pretty much $100 for a client once, no subscriptions, nothing else. It's done. All right. Uh, is it recommended for personal portfolio if you don't have BA clients, i.e., not a BA? Honestly, definitely, right? It's just if you're doing it for yourself, then the main thing that you need to think about is how are you building your strategy, right? But you can always, if you can use the software, but you can also book in a strategy session with Zapiio, or you can even reach out to us at Pathway Property, and we're more than happy to help out, right?
Yeah.
Now, so basically, there's 2 directions to go. Josh, could you drop the link for how they can sign up if they not through HTAG, just directly?
So just so to elaborate on what you said, yeah, I'll chuck the link in the chat. So if you're through HTAG, the partnership fee is waived. If you're not through HTAG, it's $850 lifetime for the partnership and white labeling, and you get 2 credits, but we're going to give you an extra client plan. The portfolio tracker, you can just use the get invite link and invite as many of your clients as you want, previous, current, future, whatever. And what that does is it puts them in your client list for you to nurture those people, identifying what their any opportunities, if they've got equity borrowing capacity, if they've got crappy properties and they need a portfolio review. Arshad's used it a bit already. We've got many people that are just generating leads out of that. Very important. And then the $100 per plan. One thing to note, if you want to do it just for your own personal use, you want lifetime access just for your own account, you're not a buyer's agent. You can get lifetime access to run your own scenarios in your investor account. So there's like an investor, which is what your clients would have, and then there's the buyer's agency side, and that's called Pro Tools, but it's just applied to your own account, and it's $199 for lifetime. The reason why we've done that is, look, playing around with it yourself is probably the best way to get amongst it. Or you can just, yeah, you didn't hear this from me, but if you just add yourself as a client, you pay $100 instead of 199. I shouldn't tell you that, but it doesn't matter. But yeah, basically that's the lay of the land on the pricing. We just want to make property strategy transparent and accessible to everybody. I don't think that anyone should not have a plan. And at the moment, we've got this like really unique situation where everyone wants to visually see it. They want to replace their spreadsheets. They want a forward-looking plan, and they're not really getting provided with it. But if you can increase the lifetime value of your clients, that's a big tick in the box. But just add value to like just generally add value to people. So
Yeah.
yeah.
Nice. Now, another question we have here is how is Zapiyo different from its competitors, right? Now, just as a user, I'd say a few things, right? Number one is it's a lot more detail oriented. I've found a lot of the competitors are they don't get into the details and it just kind of becomes this thing where it's like, it doesn't actually show what's possible. It's just a bunch of graphs and you show them the graphs going up. It doesn't give them a real plan. Whereas this, it gets into enough detail and that it's specific enough that it's actually realistic, number one. Number two, it's very user friendly and easy to use. And then number three, in all honesty, this is the big one for us as for the buyers agents over here is I think it's very reasonably priced. Honestly, like yep, it's a very, very affordable, right? So that's that's something to those are I'd say the main ways it compares to its competitors. Anything else, Josh, that you think to
Uh, Look, to be honest, what we've tried to do is incorporate a simple system to use, complex scenarios if you want to. So you can do companies and trusts and all sorts of creative structuring if that's the way you want to go. But we keep the usability. The one like core difference with other software, and I'm not too familiar with many of them, but basically this is we're ensuring we want to be as accurate as possible. We want to be able to change things realistically at a point in time. For example, get your broker in, you can invite your broker in and get them to add evaluation at a point in time, updates numbers, change rent at a point in time, add granny flats, do everything the way you would actually do it to build a normal portfolio. And then obviously portfolio tracker is its own independent thing, and we build off that portfolio tracker for scenarios. So it's distinctly different in that we have a client list with a portfolio tracker that everybody should have access to. And if they're your clients, you don't have to pay for advanced level access straight away. You might give them the access to the portfolio tracker, and that's a core difference. There's no real other software that's got everyone's portfolios in one location for you to nurture that list of people and identify opportunities. The other thing too is, we are going to be pulling data, and we've got some integrations happening. We've actually got multiple integrations happening, and we also base everything off financial years and have ATO tables and CGT calculations automatically calculated. It's not just an assumption. So when you're looking at it on face value, there's a lot happening behind under the hood to make it as accurate as possible in the context of portfolios building.
beautiful. Any final questions, anyone? Actually Q&A. So beautiful. Yeah. Okay, let's dismiss. Dismiss. White label. So yes, white labeling is possible. It's there as part of HTAG and
And
uh
outside as well. So yeah. So that initial partnership fee basically is the lifetime. You get your logo. We're going to be bringing in some color palette changes, which sounds ridiculous, but we're going to have like primary color, secondary color palette changes eventually. We can change it, make it as fancy if you've got pink or whatever you want to put on there. But yeah, you can put your logo, your business name in there. It all looks like your brand. And the invitation link that you send to clients, it's the white labeled page. So just please put your logo in there and your business name. And so when you send the link to them, it will say Zapiyo say Pathfinder property. But however, basically that link goes straight into your client list. then they come only onto the portfolio tracker. You have to manually upgrade them if you want to upgrade them. But that's all white labeled. So you can bring them in.
Nice.
It looks like your own software.
So, so the tool is accessible from within. Is the tool accessible from within HTAG? Yes, Richard, it is. So if you're on HTAG, you click on the section that says Get Started on the top in the menu bar, and then there'll be a thing that says Portfolio Modeling. If you click on that, Zapiio will open up. Josh, is that only available for people on the professional plan for HTAG, or is it available for everyone?
If you're an investor level, you get an investor account for your own portfolio to build out.
Yeah.
And then if you're a professional, you get your own investor level and a professional. So when you click on it, it'll automatically create your thing, and all you need to do is change your settings and change your business name and stuff. But yeah, so to answer your question in short, if you're a professional or elite member, you'll
Yeah.
get the access straight in.
Zapiio Professional.
Yeah, the agency account. Uh,
Yeah.
there's two accounts, right? There's investor and agency. Your clients would use investor, or if you want to do it yourself for your own portfolio, you use investor. And you just click in the top right corner and you go switch accounts, and you can switch between agency and your own personal. Some people don't want their name in their client list. It depends on what you want to do.
Then is there a set of demo videos I can watch? Yes, there is. They are. They're on the community mastermind for HTAG. Are
I'll,
they anywhere else right now, Josh, those videos?
I will send you a link to a file, like a folder that's got them all in there.
Done. We'll share that with all of you right now. We'll share that with all of you right now so you can, or not right now, in a follow-up email. If you go on the mastermind under portfolio modeling, there's a Zapiio FAQ. Richard, reach out to me and I can directly help you with some of that stuff that you're looking.
Dilip, you're not a HTAG member, that's fine. So how much I think the cost per credit is the same. It's $100. We are flexible on that. So we've had multiple buyers agents buying bulk because they're just using it for every client. If you want to do that, just reach out to me directly and we can talk about it. I'm pretty flexible. In terms of so I'm not the hashtag how much credits will I get and what's the price. So if you pay the 850, we're going to give you 3 credits. So we know who's attended tonight. We'll give you 3 credits. Actually, I'll make it 4 credits this time for everyone that's attended. I appreciate you rocking up. But yeah, so that's what you'll get. So 4 client plans basically included.
Yeah, and then from there to add each additional one, $100, right? And it's $100 once-off fee.
Yes. Yeah.
Beautiful. Any final questions, Josh? Really appreciate you making the time. I thought this was a good session. I think it's like, to me, just showing that the clients that transition from residential to commercial and how much the cash flow jumps up. It's it's just I think it gets them so excited about their portfolio. Because like for a lot of them during the residential investment phase, their portfolio is negative cash flow. They start to think, is it even worth doing this? There's all this little random crap coming up. But when you show them that, hey, if you keep doing this for 15 years and you sell it off and buy that commercial, you're going to have 200K net passive income. Then they're like, damn, now I know why I'm doing this, right?
And
And
I
then,
guess combining that with the goal setting process at the start and hitting their goals. So like we could have really dialed that portfolio in like massively.
yeah,
Um, the other thing too is we would have achieved the goals faster. The goal would have changed had
yeah,
we split the income between 2 people, right? So there's a few things at play here, but I guess one thing to consider is that doesn't necessarily have to be commercial property. Someone asked a question about other asset classes. Building the foundation and building the residential portfolio, getting at
yeah.
the net cash flow. We always the cash pool. We always talk about that gives you options. So whatever the case may be at that point in time in your life, 40, FY40, FY50, you've got options though, right? So
There's always options, yeah. Beautiful. Any final questions for Josh or myself? If not, jump on what's it called? On Zapiio, jump on HTAG. How is this different from Suburb Finder Portfolio Tracker? In all honesty, I'm not too sure. I've never used Suburb Finder Portfolio Tracker. Uh yeah, I can't answer you, Dilip. Just
for sure, I don't know much about it, but yeah, I guess for us, you can send it out to all your clients and have and nurture the clients in one location, and then build the strategy on top of that.
Yeah.
So I'm unsure. Sorry, I can't answer your question very well. So
Yeah. I think the main thing over here is it's like it's purpose created for portfolio tracking, and it's like hyper specific, right? And I think yeah, it looks I think that's it's
actually takes into account your financial position in terms of your
yeah.
income, the ATO, and the distribution of cash flow, and then applies a net number. I don't know. I could have a look at it. But yeah.
Yeah, I think the main thing that I've found with Zapier compared to others is, or the other ones that I've seen, is the level of detail that it goes into actually provides you with realistic outcomes. Whereas the other ones is just like, it's not realistic. It's just there to show clients graphs trajecting upwards. At least that's been my experience. Yeah. Anyway, guys, I think let's tie it off there. Hope you all have a lovely night. And again, feel free to reach out to Josh, reach out to myself, and jump on it. It's an easy way to improve the value you're providing to clients, but also on top of that, get your clients more invested in building and growing their portfolio. Thanks,
Uh,
everyone.
yeah, thanks very much for coming, guys. I'm going to drop a link into, if you want a personal walkthrough, if you are interested, I'll drop a link in the chat now. And yeah, go from there.